Alright, so what if I told you there was a simple valuation metric that you were using to analyze stocks, but that you truly don't understand how it actually works? And that using this valuation metric incorrectly could cost you thousands, if not millions of dollars in lost stock market opportunities throughout your lifetime. Hey, what is going on, guys? My name is Nick, and recently I've been reading the book One Up on Wall Street by Peter Lynch, which I would highly recommend to anyone wanting to become a better investor. And near the end of the book, I came across this one subtle yet extremely important tip about stock valuation that every investor picking individual stocks must understand, which made me realize I had to make a video about this. So if you do gather any value, make sure to give this video a thumbs up and please consider subscribing down below so you don't miss any of my future content. Anyways, starting off with a bit of background, there are quite a few tools investors can use to help determine the valuation of a stock. Firstly, there's the detailed approach involving a discounted cash flow analysis to come up with the intrinsic value of a company based on its future estimated cash flows. Most of the time, however, we don't want to go through all of that effort to analyze a stock if there are hundreds in our watch list. So the second and most common approach to stock valuation is to use some comparative metrics such as the price to earnings ratio, the price to book ratio, or the price to sales ratio, to name a few popular ones. But there's one specific valuation metric that we'll be discussing in today's video that many investors simply don't understand deep down, and that would be the price to earnings growth ratio, or the PEG ratio. Now I know you're probably thinking, Nick, I already understand the PEG ratio fully, no need to explain it. But just hear me out because you might be very surprised with what you don't know. Before reading One Up on Wall Street, I thought I fully understood the PEG ratio too, but after reading, I realized there were a few key things that I was missing. Now the PEG ratio is simply an extension of the price to earnings ratio, or the PE ratio, which is calculated by taking a company's stock price and dividing it by the GAAP earnings per share over the past year. Simple, right? And one might also call this the trailing PE ratio since it's based on the trailing 12 months of EPS. And as for the PEG ratio, it's calculated by taking this trailing PE ratio and dividing it by the company's expected EPS growth rate over the next 5 years, which can be found from sources like Yahoo Finance. For example, let's consider TD Bank, which has had consistent earnings growth over the past 5 years, aside from the COVID hit in 2020. So in 2021, TD generated $7.72 of GAAP EPS, while the current share price is $105.62, which means that the stock is trading for 13.7 times its trailing 12 months EPS. Using this trailing PE ratio, we can now calculate the PEG ratio by finding the expected EPS growth rate over the next 5 years, which analysts are predicting to be 17.5% per year on average. So TD's PEG ratio is calculated by taking the trailing PE ratio of 13.7 and dividing it by 17.5, equaling 0.78, which is pretty straightforward. Now then, you might ask, what would be considered a good PEG ratio? Since the PEG ratio accounts for a company's future EPS growth rate, we can generally use it to compare any company across any industry, as opposed to the PE ratio, which will vary significantly from company to company and industry to industry. Investopedia says here, PEG ratios higher than 1 are generally considered unfavorable, suggesting a stock is overvalued. Conversely, ratios lower than 1 are considered better, indicating a stock is undervalued. So based on this definition, TD stock looks pretty cheap with a PEG ratio of 0.78, which is below 1. However, now comes the caveat and the big misconception about the PEG ratio. I'm here to tell you that what Investopedia says about the PEG ratio is factually incorrect, and to illustrate why, let's do a simple comparison between two hypothetical companies. Alright, so let's say company A has a stock price of $100 per share and $10 of EPS, giving it a trailing PE ratio of 10, but let's also assume company A is expected to grow EPS at 10% per year over the next 5 years, which would give it a PEG ratio of 1. As for company B, it will have the exact same stock price as company A, but half the EPS, giving it a trailing PE ratio of 20, and let's assume company B is expected to grow EPS at 20% per year over the next 5 years, which would also give it a PEG ratio of 1. So as we can see, both company A and company B have PEG ratios of 1. Now my simple question for you is, which company is the better investment, assuming these two companies have basically identical business models? Well, the answer is company B is a better investment, even though it has an identical PEG ratio to company A, and here's why. When we project the EPS out 5 years into the future, we can see that company A will generate $16.11 of EPS, while company B will generate $12.44 of EPS. But although company B would have less profits than company A, company B will still likely be growing earnings faster than company A at this time, but slower than it has in the past, so let's assume 15% per year future EPS growth. So to keep the PEG ratios equal to 1, Company B's PE ratio would now be 15, while Company A would remain at 10, assuming it is still growing EPS at 10% per year. Well, after calculating the final share prices, Company B would be at $186.62, while Company A would be at $161.05, showing that Company B is the clear winner here, despite both stocks starting with the same PEG ratio and stock price 5 years earlier. Now keep in mind, these are just hypothetical estimates of what the PE ratios could be after 5 years, but in reality, they would likely fluctuate up and down quite a lot over time. However, the difference is clear, and it becomes even more pronounced when we increase the earnings growth rate for Company B. For example, let's say Company A stays the same while we increase Company B's EPS growth rate from 20% to 30%, and we change the PE ratio from 20 to 30 to keep the PEG ratio equal to 1, like in the last example. We will also assume that after 5 years, the PE ratio and earnings growth rate for Company B drops from 30 to 17.5 to again keep the PEG ratio equal to 1. In this case, we can see that Company B significantly outperforms Company A despite both companies starting and ending with a PEG ratio of 1. So then we have to ask ourselves, why does this happen? Well, the answer is pretty simple. It's compound interest. Higher compounded annual growth rates, or CAGRs in short, lead to exponentially higher earnings in the future, whereas the PE ratios don't decrease at that same rate. Now, I may have lost some of you there, but just think about this for a second. If the PE ratios decreased at the same rate as the earnings per share increased, the stock price would not move. It just wouldn't go anywhere. So because PE ratios decrease at a slower rate than earnings increase for a growing company, the stock prices will rise, provided that those companies can maintain their future earnings growth rates that are expected and that they don't stop growing. To give you some more examples, let's assume that Company B now has a PE ratio of 50 with a PEG equal to 1, while Company A is unchanged. Now you can see this huge difference in performance between the two stocks with the same PEG ratio. And if we consider an absurd 100 PE ratio with 100% EPS compounded annual growth rate, keeping the PEG at 1 again, the difference becomes even larger. Anyways, getting back to what Investopedia said about the PEG ratio, where a company is considered overvalued if its PEG ratio is above 1, well, this simply is not true. Faster growing companies can afford to have these higher PEG ratios, even as high as 2 or 3, depending on the company's EPS growth rates. And this could yield the same return on investment from an identical company trading at a lower PEG ratio and a lower earnings growth rate. To illustrate this a little bit better, if we go back to the example where Company B has a 30 PE ratio and Company A has a 10 PE ratio, Company B's stock could start with a PEG ratio of 1.3 to achieve the same overall return as Company A if they both end with a PEG ratio of 1 after 5 years. And the higher the earnings growth rate, the higher the PEG ratio can be to achieve the same return as a company with a lower earnings growth rate and lower PEG ratio. Another example here, having a 50 PE ratio, Company B's stock could start with a PEG ratio of 1.9 to get the same ROI as Company A if they both end with a PEG ratio of 1 after 5 years. Or to be absurd, having a PE ratio of 100, Company B's stock could start with a PEG ratio of 2.8 to get the same ROI as Company A if they both end with a PEG ratio of 1 after 5 years. To summarize, any company trading at the same PEG ratio as another company, but with higher earnings growth rate, will generally be the better investment, assuming both of these companies are very similar. So the whole point of this exercise today was just to remind you that even though a company is trading at a higher PEG ratio does not mean that it's a bad investment and that the stock price cannot rise significantly. And a classic example of this would be Tesla stock. Right now, Tesla has a PEG ratio of 2.63, and although it looks quite expensive right now, especially having a forward PE of 90, this stock could easily continue rising as long as they can continue growing their earnings at or above expected rates year after year, since the PEG ratio will eventually collapse once the earnings growth rate slows down in the future. Anyways, I really hope you enjoyed this video and gathered something valuable from it. So don't forget to drop a like if you did enjoy, because it did really take me a lot of time to do all these calculations and make all these examples. And if you haven't already, please consider subscribing so you don't miss any of my future uploads. And with that said, I will see you guys in the next one.